Oil prices surge 1% amid Trump's Russia stance and tariff threats. Market analysis. Oil prices surge amid political tensions. What you need to know. Oil prices experienced a notable increase of 1% during early trading on Wednesday, following a significant rise of over 3% in the previous session. This uptick comes as concerns about potential supply shortages become more pronounced. On this particular Wednesday, oil prices rose as investors closely monitored the latest developments regarding U.S. President Donald Trump's intensified deadline for Russia to cease its military actions in Ukraine, alongside his threats of imposing tariffs on nations that engage in oil trade with Russia. Brent crude futures saw an increase of 73 cents, translating to a 1.01% rise, closing at $73.24 per barrel. Meanwhile, U.S. West Texas Intermediate crude also gained 79 cents, or 1.14%, settling at $70. Notably, investors appeared to overlook mixed data concerning U.S. crude and fuel inventories, despite both contracts having dipped nearly 1% earlier in the day. In a statement made on Tuesday, Trump announced his intention to implement measures against Russia, including secondary tariffs of 100% on trading partners, if there was no significant progress in resolving the conflict in Ukraine within a 10 to 12-day timeframe. This is a shift from his previous 50-day deadline. Additionally, he has imposed a 25% tariff on goods imported from India starting August 1st, along with unspecified penalties for purchasing Russian weapons and oil. The U.S. has also cautioned China, the largest importer of Russian oil, that it could face substantial tariffs if it continues its purchases. Analysts from J.P. Morgan noted that while it is unlikely for China to adhere to U.S. sanctions, India has indicated a willingness to comply, which could potentially impact 2.3 million barrels per day of Russian oil exports. Traders seem to be more focused on the tariffs related to Russia, and India's compliance is viewed positively in terms of crude prices, stated Dennis Kissler, Senior Vice President of Trading at BOK Financial. In terms of inventory, the U.S. Energy Information Administration reported a rise in crude inventories by 7.7 million barrels, contrasting with analysts' expectations of a 1.3 million barrel draw, according to a Reuters poll. Conversely, U.S. gasoline stocks decreased by 2.7 million barrels, while analysts had anticipated a 0.6 million barrel draw. Distillate stockpiles, which encompass diesel and heating oil, increased by 3.6 million barrels, exceeding expectations of a 0.3 million barrel rise, as per EIA data. Moreover, U.S. economic growth rebounded more robustly than anticipated in the second quarter. However, this figure may be misleading, as the improvement was largely due to a decline in imports, with domestic demand growing at its slowest rate in 2.5 years. Looking ahead, the Federal Reserve is expected to maintain current interest rates during its meeting on Wednesday, despite President Trump's ongoing pressure for the central bank to lower borrowing costs. But here's where it gets controversial. Are these tariff threats a strategic move to influence global oil markets, or do they risk escalating tensions further? What are your thoughts on the potential impact of these developments on the global economy? Share your opinions in the comments. Why oil prices are dropping, Trump tariffs, U.S. crude stocks driving season impact. In a surprising twist, oil prices took a dip as the market grappled with the repercussions of President Trump's tariff threats and an unexpected increase in U.S. crude inventories. Let's delve into the details. As investors pondered over the potential supply risks stemming from President Trump's aggressive stance on resolving the conflict in Ukraine via additional tariffs, the oil market experienced a notable decline. The situation was further complicated by the unanticipated rise in U.S. crude stocks, which added to the downward pressure on prices. The Brent crude futures for September delivery, scheduled to expire on Thursday, slipped by 61 cents or 0.83%, settling at $72.63 per barrel by 13:26 GMT. Meanwhile, the U.S. West Texas Intermediate WTI crude for the same month dropped by 68 cents or 0.97%, reaching $69.32. However, this downturn came as a contrast to the previous day when both benchmarks had witnessed a 1% gain. The market appeared to be reassessing the implications of President Trump's announcements, considering how his policy intentions can shift abruptly if a favorable deal arises. Harry Chilagarian, an analyst at Onyx Capital Group, noted that the market is currently in a state of reevaluation, awaiting further clarity. President Trump's recent declaration that he would impose stringent measures, including 100% secondary tariffs on Russia's trading partners, if no progress is made towards ending the war in Ukraine within 10 to 12 days, has sent ripples through the industry. Moreover, the U.S. has issued warnings to China, the largest importer of Russian oil, about facing significant tariffs if it continues to purchase Russian crude. This move has heightened tensions and uncertainty in the global oil market. Adding to the mix, the U.S. Treasury Department unveiled new sanctions against over 115 individuals, entities, and vessels linked to Iran. These sanctions are part of the Trump administration's maximum pressure campaign, following the bombing of Iranian nuclear sites in June. On the domestic front, the Energy Information Administration reported a substantial increase of 7.7 million barrels in U.S. crude oil inventories, reaching 426.7 million barrels in the week ending July 25th. This surge was attributed to reduced exports, contrary to analysts' estimates, expectations of a decrease of 1.3 million barrels. However, gasoline stocks witnessed a significant drop of 2.7 million barrels, plummeting to 228.4 million barrels. This decline far surpassed forecasts of a 600,000-barrel reduction. Analysts suggest that the decrease in gasoline stocks supports the notion of robust demand during the driving season, thus having a neutral effect on the oil market. This complex interplay of factors has left the oil market in a state of flux, with investors closely monitoring developments and waiting for clearer signals. As always, the global oil landscape remains unpredictable, with various geopolitical and economic forces vying for dominance. Oil prices surge. Trump threatens India with tariffs over Russian crude. Market analysis, July 30th. In a dramatic turn of events, the oil market has surged to its highest point since June, leaving investors on edge. The catalyst? U.S. President Donald Trump's bold move to penalize India for its purchase of Russian crude oil, a decision that has sent shockwaves through the global market. This bold action has sparked a whirlwind of speculation about the potential tightening of global oil supplies, leaving market analysts and investors alike holding their breath. West Texas Intermediate, a key benchmark for oil prices, soared by 1.1%, settling at a staggering $70 a barrel. This is the highest it's been since June 20th. He criticized India for being one of the largest consumers of Russian energy, a move that has not only raised eyebrows, but also heightened tensions in the global oil market. But here's where it gets controversial. India's Nayara Energy, a significant player in the oil refining sector, has responded to these measures by reducing its refinery run rates. This move, in turn, has sparked fears of an exacerbated tightness in refined product markets, a situation that could potentially spill over into oil prices. The ripple effects of this decision are far-reaching, impacting not just India and the U.S., but the entire global oil market. And this is the part most people miss. The implications of these actions go beyond immediate price fluctuations. They highlight the complex interplay between geopolitics and the global economy, a dynamic that is often overlooked in the rush to understand short-term market movements. This situation raises important questions about the role of major oil-consuming nations in shaping global oil prices and the potential consequences of political decisions on the stability of the oil market. So what do you think? Is Trump's move justified, or is it a risky gamble that could destabilize the global oil market? Share your thoughts in the comments below.